Historical analysis of the last 4 millennia reveals a consistent pattern in the survival of wealth during periods of extreme financial catastrophe. The distinction between assets that depend on societal trust and those with intrinsic value becomes critical when established systems begin to fracture. A fundamental contrast is observed between the diversified portfolios common in urban centers and the tangible resources held by those in rural or productive sectors. The 1929 Great Depression serves as a primary example where diversified investments in stocks and bank deposits were wiped out while physical assets persisted. In that era, an accountant with a theoretically safe and balanced portfolio lost everything due to the total collapse of the banking system. Conversely, a farmer possessing productive land and tangible reserves found that his wealth increased as the general population struggled for survival. The collapse of the financial system in 1929 demonstrated that paper-based wealth is entirely dependent on the continuous functioning of institutional trust. When that trust evaporates, the economy reverts to a more primitive state where only essential commodities and resources hold true bargaining power. The first of these resilient categories is productive land, specifically acreage capable of generating food, minerals, or water sources. Productive land is distinct from suburban residential property because it serves as a primary source of life-sustaining materials. During the hyperinflationary crisis of Weimar Germany in 1923, the national currency lost its value so rapidly that it was used as fuel for stoves. While urban savers were unable to purchase a loaf of bread with their lifetime savings, farmers outside the cities became a new economic aristocracy. A single livestock animal could be traded for high-value items like grand pianos or family heirlooms as the city population faced starvation. The historical record in Germany shows that those who controlled food production could demand payment in any stable medium they desired. This pattern of agricultural resilience was repeated in modern times during the economic collapses of Zimbabwe and Argentina. When a currency dies, the economy does not simply vanish, but instead shifts its focus toward the fundamental requirements of survival. Ancient Roman history confirms that land was the only form of wealth that remained immune to the persistent debasement of the currency. As the silver content of the Roman denarius dropped by 95% over 2 centuries, landowners continued to eat while speculators were ruined. Modern institutional behavior reflects this historical lesson. As seen in the massive acquisition of farmland by the world's wealthiest individuals, large-scale private ownership of agricultural land serves as a strategic hedge against the long-term effects of global currency devaluation. The fundamental equation of land producing food remains independent of the decisions made by central banks regarding interest rates. However, land as an asset carries specific risks, including the potential for government confiscation or nationalization during political upheavals. It is also characterized by low liquidity, meaning it cannot be quickly converted to cash during the height of a sudden crisis. Despite these drawbacks, productive land has never lost its total value in 4,000 years of recorded human history, while currencies, bonds, and corporate equities frequently fall to zero. The value of land remains tied to the essential commodities it yields. The second enduring asset is gold, which has functioned as a universal default currency during every major systemic breakdown. Gold does not derive its value from a government decree, but from its mathematical scarcity and universal recognition by human societies. When a fiat currency fails, the immediate need for a medium of exchange leads people to revert to precious metals. During the period between 1929 and 1933, the broader stock market fell by nearly 90%, while gold-related assets saw significant appreciation. The purchasing power of those holding physical gold remained intact during the Great Depression, while paper-based wealth was largely incinerated. In more recent crises like the 2008 financial collapse and the 2020 global pandemic, gold reached all-time highs as a response to massive money printing. Current trends show that central banks around the world are accumulating gold reserves at the highest rate in over 3 decades. The very institutions that issue paper currency are choosing to store their own reserves in an asset that cannot be manufactured out of thin air. This behavior suggests a strategic acknowledgement that gold provides an ultimate level of solvency when other financial instruments fail. Gold is not without risks, as evidenced by the 1933 executive order in the United States that made private gold ownership a federal crime. It is also subject to long periods of stagnant pricing and does not generate any form of passive income or dividends. Its primary function is not to make the holder wealthy during stable times, but to ensure survival and liquidity during total collapse. The third asset category involves businesses that possess significant pricing power over essential products and services. Pricing power is the ability of a company to raise its prices faster than the rate of currency devaluation without losing its customer base. Enterprises that provide non-discretionary goods such as energy, medicina, cooking oil, and basic utilities are best positioned for this. In the hyperinflationary environment of 1980s, Brazil, supermarkets were forced to update prices multiple times within a single day. Companies selling essential commodities maintained their profit margins because consumers had no choice but to pay the updated rates. Conversely, businesses operating on thin margins or those locked into long-term fixed-price contracts were quickly driven into bankruptcy. Historical spice merchants in medieval Venice utilized a similar form of pricing power by controlling the supply of essential trade goods. When wars or currency fluctuations occurred, these merchants simply adjusted their rates to reflect the new economic reality. In modern economies, large-scale consumer goods and energy firms often report record profits during inflationary periods due to this inherent leverage. Pricing power acts as a protective shield for capital, allowing a business to act as a pass-through entity for rising costs. However, this power can be neutralized by government intervention in the form of price ceilings or the total outlawing of private trade. Historical precedents show that when governments attempt to force trade at a loss, supplies vanish and black markets emerge. The final and perhaps most valuable asset is the possession of specialized, practical skills that serve basic human needs. Skills represent a form of capital that requires no upfront financial investment and cannot be seized by any government authority. During the extreme hyperinflation of post-war Hungary, where prices doubled every 15 hours, skilled tradespeople survived by bartering. A plumber or electrician could negotiate for food and essential services, while those on fixed government salaries were left with worthless paper. The demand for individuals who can heal, build, and repair remains constant regardless of the state of the financial markets. In a barter-based economy, the person who can fix a leaking pipe or restore power has more bargaining power than a bondholder. Current labor trends indicate a growing shortage of skilled manual workers as younger generations move toward digital and office-based roles. While white-collar professions are increasingly threatened by the rise of artificial intelligence, manual trades require physical presence and tactile problem-solving. A skill set tied to basic infrastructure provides a portable and durable form of wealth that functions in any economic climate. The primary risk to this asset is the potential for specific technologies to become obsolete, necessitating a focus on fundamental human needs. The four assets: land, gold, pricing power businesses, and skills share three critical filters that define their resilience. First, none of these assets can be created out of thin air by a central authority or a printing press. Second, each asset addresses a fundamental human requirement that persists even when discretionary spending disappears. Third, every one of these assets has a proven track record of surviving systemic collapses across thousands of years of history. The most robust wealth resides in resources that exist independently of the promises made by financial institutions or governments. Preparing for potential instability involves assessing whether one's current holdings can pass these three filters of scarcity, necessity, and history. When the financial system experiences a major crack, the only assets that retain value are those that cannot be wiped out by decree or devaluation. In the editor's opinion, the modern obsession with digital and speculative wealth has created a dangerous disconnect from the physical foundations of the economy. The lessons of the last 4,000 years suggest that true security is found in the things that remain when the systems of credit and trust fail. By focusing on tangible assets and practical abilities, individuals can insulate themselves from the inherent risks of a debt-based global financial structure. The most rational investment strategy for an uncertain future may not be found on a trading screen, but in the acquisition of fundamental resources and the mastery of essential trades.